Federal Reserve policies have been weakening and distorting the economy rather than providing stimulus. The policies are hurting savers, distorting markets, and redistributing capital rather than increasing it. The policies subsidize government, big corporations, big banks, foreign investment, and gold, none of which is a robust private sector job creator, and it comes at the expense of small and new businesses and other job-creating parts of the economy.
I think this caused enormous risks. It's a two-sided risk. One, inflation may pick up if the Fed can't undo this ease fast enough. And number two, it's a downside if they bring the funds back too quickly. That's a downturn. It's contractionary. So there's this risk overhanging the financial system and the economy. I think that's a drag on growth. Firms are sitting on a lot of cash. Actually, some consumers are now sitting on a lot of cash. They don't want to go out and buy things with that uncertainty. I think it's already a drag. This is not our future risk. This is a current risk. When you talk about risks and benefits or costs and benefits, the costs are now greater than the benefits, and it's a great concern to me. It's one of the reasons unemployment remains high.
What should we do? What would the correct monetary policy be absent the one that we have now?
So my thought is to stop digging the hole deeper. And so the Fed is taking on more and more burden and giving people longer and longer term promises of zero rates. And I think it should be walked back, and that would allow the economy to begin functioning more naturally and the capital allocation process to resume.
Dr. Meltzer, Dr. Taylor?
I think you need a rule. You need to exercise greater discipline over the Fed. No one, as I said in my testimony, should have the authority to increase its balance sheet as much as it does without any congressional oversight.
I think it's quite remarkable to me, a lot of the concerns I have about monetary policy, the unconventional, the unpredictability, also characterize fiscal policy. I mean, they go together, and you know, it hasn't always been that way. We used to have a regular order for budgeting. We don't have that anymore, so it's unpredictable. So I think the more that fiscal and monetary policy can get more predictable, get more sensible, like you're trying to do, the better off the country will be.
Today's hearing does what? Seeks to examine in greater detail the role that Fannie and Freddie Mac played in facilitating the 2008 financial crisis. Over the last 4 years, there's been a great deal of discussion as to what the main causes of the financial crisis were. However, I believe there's one similar fundamental trait that connects every analysis, and that is bad mortgages.
Who lowered these lending standards? We know now it was government policies. Why was it that we agreed to zero-down mortgages? Government policies. Who agreed to the so-called liar loans? It was government policies. And who pushed Fannie and Freddie to buy more and more of these inferior performing loans? It was government policies. And why did no one in the lending chain ever be willing to say no in a game that was destined for failure? Well, we know now it was because a lot of people made a lot of money on selling inferior products. And why? Because of the implied promise that if anything went wrong, don't worry, the taxpayers would bail it out and the taxpayers would pay.
In the mid-1990s, the GSEs were repurposed to direct social policy through the mortgage markets. The combination of using the GSEs as tools of social policy and falling interest rates built the foundation of the housing bubble.
This hearing says Fannie Mae and Freddie Mac, how government housing policy failed homeowners and taxpayers and led to the financial crisis. Mr. Ligon, is that a fair assessment?
It's a very fair assessment. Without Fannie and Freddie, it's entirely likely that the vast expansion of mortgage finance could not have taken place. GSEs were always backed by the federal government, and they've continued to expand their mortgage holdings at all quality levels, including dangerous increase in risky holdings, and that entirely weakened the entire financial position, and that in turn required even more government support.
I'm just wondering, what came first here, the chicken or the egg? Were Fannie and Freddie the ones that led the charge to decrease underwriting standards, or were they innocent bystanders as things went haywire?
Well, as you point out, they did lead the charge. And frankly, it's not just the easing of underwriting standards. I think it's very important to remember that it's easing of underwriting standards and reductions of down payments. And that's critically important because the foreclosure rates would be significantly lower nationally if people had equity in their homes as home prices were falling. And the GSEs, again, led the way to lower down payments.